and welcome. You're watching NDTV Profit. This is Mahima Vachrajani. Tata Communications is focused on the back of Q3 results, and today we have with us Mr. Kabir Shakir, CFO of Tata Communications, with us to give us a view on how the quarter has gone by and what is the future outlook. Welcome, Kabir. About the results, there is growth in revenue. However, margin growth is flat. Do you expect to have the same revenue run rate and maintain margins at the same level? And what are the factors do you expect that will contribute to them?
Yeah. Thanks for having me. I think firstly we're quite delighted that we have crossed the 5,000 crore mark in a quarter. This quarter, overall revenue crossed the 5,000 crore mark. Our data revenue crossed the 4,000 crore mark, and we reported 4,618 crores of data revenue. I must hasten to add that this is on the back of the Kaleyra acquisition that we have actually done. So we've reported a 24.4% year-on-year growth. But even on an underlying basis, our data revenue grew 6.6% year-on-year. So that's a growth rate that we are quite happy with. I must also remind that only a few months ago we unleashed and unveiled our ambition to double our data business by FY27, and soon after we made that announcement, a month and a half later we went on to announce the acquisition of Kaleyra, and I'm delighted that we closed the acquisition in a record time. So 6th of October we actually did close the acquisition. So almost barring 6 days we had the full effect of Kaleyra in our financials in this quarter. On margins, I would say, Mahima, that we are actually, beating the street estimates, because mathematically, if you just add up the loss-making Kaleyra, business that we acquired, we would have probably been a little lower. But there has been a focus both on our core margins, as well as we're happy to state that we have fast-tracked the cost synergies that we had identified as part of the acquisition. Already in the very first quarter, the loss-making Kaleyra business has turned EBITDA, break even already. Plus the earlier acquisition that we did in May, of last year, Switch is progressing faster towards an EBITDA break even. With these two, I would say we are quite happy with where we are, in terms of our EBITDA numbers. Going forward, I would say only one thing. We are committed to the 23 to 25% ambition that we have for our EBITDA as our long-term, goal post. And in the next few years, we will get back to the 23 to 25, which has slipped as a result of these acquisitions and the organic investments that we have actually made in the business.
Okay, great. So you do look forward to a 23 to 25% EBITDA going forward in the coming quarters. That's great. Also, your income from voice solutions has been declining quarter on quarter. Why is that? Is there a change in segment mix that you're focusing on, or do you plan to ramp up the voice solution business as a whole?
Mahima, voice is not our focus. Voice, as you know, is a declining business globally. Although we are declining slower than the market, but that's not a business of focus. That's why strategically, whenever we talk any markers, we've always been talking data. We will probably find an answer for how and where we manage the voice business in a responsible way. But the focus of the management is not on voice.
Okay, fair enough. And what are your plans with the real estate segment that you have? Any new projects in the pipeline?
I mentioned earlier, and I will probably repeat that we have a very well articulated real estate strategy, which is signed off by the board. We have land parcels, and ideally, my endeavor is to match the cash inflows from the monetizing of these properties with the cash requirements that the business needs, both organically and inorganically, so that we are able to manage the cash and are not required to go and borrow cash from outside to support our ambitions. So that is going to be the plan, and the team is working overdrive because a lot of the land parcels have issues on clearing the title deeds and the classification and all sorts of stuff. So all of that work is actually going on, and we have identified and timed certain properties that we would want to monetize in the next couple of years. So that plan is in motion.
What does your order book look like as of today, and how many new customers could you add in this quarter?
I mean, not new customers. What we track. I mean, new customers are. It all depends because we have a focus on our top 300 customers, then the next 700, and now we have a different focus on the G50 customers as well. So that list doesn't change. Of course, the list will the digital led sales model covers the tail end of the customers. But what we track is the $1 million customers, and we do report on an annual basis. We are making very healthy progress in adding $1 million customers to our $1 million club, if I may call that. So that is going on quite well. Our revenue growth had been I would say slightly muted because of the macroeconomic conditions that we actually see, which has resulted in delayed decision making. And that is reflected, I would say, in the funnel as well. Our funnel growth last quarter has been really good. This quarter, that growth has, I would say, decelerated a little bit, but I wouldn't call it a cause for worry, as we are committed to delivering, double-digit growth and delivering, doubling our data business by FY27. That ambition is quite clear, and we are steadfast on that.
Okay, that's great to hear. Also, in your last interview with Neeraj, you had mentioned that you'll be investing on creation of intellectual property as well as stepping up sales and operations in international geographies. Can you throw some light upon this? Have you made any progress in this quarter with respect to this?
Absolutely, Mahima. I mean, if you actually see our color acquisition, a lot of our business is also outside of India as well. Aside the inorganic bit, even the organic bit, if I actually were to look at most of our international geographies, barring one, has demonstrated growth rates of over 20%. So we made clear investments of account management and customer success in the international geographies already, and that is already giving us results.
Okay, and you'd also mentioned that you aim to build each of your business vertical into $1 billion enterprise in the next 5 to 7 years. Do you still stand by that, and how do you plan to achieve it?
I had specifically talked about businesses in the incubation and the digital portfolio, each of them, having the potential. The core connectivity has already crossed $1 billion, so there's no point in talking about that. In each of the, these verticals, let's talk about whether it is media, whether it is Move and IoT, whether it is the entire customer interaction suite, as we actually call it. So with the help of the color acquisition, we are very much, I would say, on track going towards, $1 billion. The Move business and the IoT business also has the potential, of getting to $1 billion. The media business, with the, I would say, acquisition of the switch, which is albeit a smaller, business, but only present in one geo, which is the US. So it gives us a good footprint there in the US, but also gives us capabilities, not just of video transmission, which we already had and strengthened in the US geography, but also of video production, capabilities that we can take to the rest of the world. So all of these have great promises of each becoming $1 billion business. So I am and my management team is completely focused on that objective.
Okay, that's great to hear again. Also, you had mentioned that you expect capex outflow of approximately $250 million to $300 million. Do you still maintain that? And is there any change in plans? And how much of this have you actually spent so far?
We are on track. I mean, as I said earlier, last year our capex was muted, not because we did not want to spend it, but just because of the delayed deliveries of in supply chain that we actually had. They had not come up for payment, so they did not get reflected in the cash flow. So those are getting reflected in the cash flow. So we are on track to spend that amount. But I would say that we are trying to maintain the capex to revenue ratio almost at similar levels. I'm not greedy to see leverage on that line, very soon. I don't want to, because I want to drive, investment in line with our aspiration to have a double-digit growth business consistently, which therefore means that going forward next year onwards, we would like to come closer to 300 million and maybe exceed, 300 million, because the way in which I would like you to read it is more capital means more growth. We are an infrastructure, led business. We are a capex, led business, although, a lot of our focus is improving the quality of our revenue through services. But that is going to be completely backed by capital investment that we need to do for every customer. So therefore, I will not starve the business of capital, and we would try and maintain, and increase our capital. And in the same breath, let me hasten to add that we are also committed to a ROCE target. So we would like to, be committed to delivering a ROCE on a steady state basis of greater than 25%. This quarter, it has dipped because of the color acquisition. Obviously, we have a loss-making business that's come into our fold. So both from a numerator and the denominator, it's a double whammy for us. But we will get back to, and we are committed to the greater than 25%. So I want, all of us to stay in that comfort that while we increase our capex outflow, that is directly to support growth and will give us the right profitability thresholds, so that is seen in the ROCE as well. So that gets completely triangulated.
Absolutely. I totally agree with the fact that more capex means more growth for a company like Tata Communication. My last question to you would be, what is the outlook for FY24 and 25 in terms of top line and bottom line? If you can just give me a rough number.
Mahima, I've stayed away from giving any outlook at all. That's, I don't think, helpful, for us. What we are committed to is certain parameters that I have always been consistent, and we've been consistent in delivering that in the last 8-10 quarters. We want sustained double-digit competitive profitable growth, and we have stepped up that growth ambition by saying that we will double our data business. So we are committed to that. We are committed to steady state 23 to 25% EBITDA range. We are committed to that. We are committed to a strong balance sheet with net debt, under 2x, and delivering a ROCE of, greater than 25%. So that commitment stays. With the inorganic acquisitions that we have done, we will depart from those numbers for a temporary period of time, and hopefully in a few quarters, we will get back to that steady state. And I do believe that steady state shouldn't last long, because we should then get on to the next, bandwagon of investment, so we can propel the company to the next growth, trajectory. So that's, what my simple, outlook would be, that in the medium to term, that up to FY27, that we have committed to doubling our data business, we are committed to that.
Right, so sustaining and maintaining double-digit growth will be on the outlook for the coming quarters and years. That's good to know. Well, thank you so much, Kabir, for taking out your precious time and giving your interview with NDTV Profit. Thank you so much.
Thank you very much. Thanks for having me, Mahima.
Good morning, welcome. You're watching NDTV Profit. I'm Hersh Sayta. We have a special guest today with regard to earnings, of course. That's in focus. That's where, at least directionally, we are also seeing a lot of action where markets are concerned, and we have with us the CFO of IIFL Finance on the back of a decentish set of numbers. In fact, a strong set of numbers in the given environment, I would say. Let me quickly welcome our guest, Kapish Jain. Kapish, firstly, welcome to NDTV Profit. It's good having you here.
Thank you very much. It's my pleasure as well.
Right. So, Kapish, it's a tough interest rate environment. Rates have gone higher. But where I'm looking at your NII as well as your NIM movement, it's actually come in better than what most would anticipate. So what is happening here? Talk to us about what's aiding your margins in a very tough environment with regard to rates. Of course, later in the year, we will see, hopefully, the rate cooling cycle come through, which should aid your margins. And therefore, I want to try and understand how the trajectory will move. How is it going right now and how will it go through the year?
Okay, so the NIM is a factor of your yield and the factor of your cost of borrowing. And so there what's happening is, with the way we have been performing and showing consistency in our delivery, that has helped us in getting dominant position in many markets. That has helped us in getting a scale and a size, which is helping us impress upon for a better credit profiling for us, not just with the banks, but also with our rating agencies. If you notice, just in the recent quarter, we got an outlook change from CRISIL, so we became AA with a positive outlook. We also got a recent rating from India Rating, which is again pegging up at AA with a positive outlook. So these are few developments on the rating side, which helps you then get to a better credit profiling to your lenders, and that helps you getting better borrowing rates. Then internally as well, when the lenders measure you, they do have an internal rating scale as well. These avenues helped us in getting better negotiation skills to get our borrowing costs lower compared to what the market has been moving up, and therefore our movement in the borrowing has not been too significant. It moved up by around 27, 28 basis points in the last 12 months compared to how the rates have moved in the external front. Second, on the lending side, yes, our expansion has helped us getting closer to our customers, and getting closer to our customers in geographies which are relatively lesser competitive has helped us in passing on some of the rate increase as well. And with that, even then, we've been able to get to a scale of business growth as well. Both these elements has helped in getting and maintaining our NIM to the level where we are. Just to talk about our spread moved up from around 5.7 to around 8.2 in the last 4-5 years, which is a mix of the way we have been able to get our pricing expanded on the lending side and better borrowing from the domestic market and the offshore market as well. And and also the mix. So if you notice, there've been little faster growth in our microfinance business with the opening of that sector. So some of the mix change also helped us in getting to our overall yield, which is aggregating to a higher level. So all these elements have really worked. Purely a case of execution and delivery with a focused approach on the outcome.
Sure. So where do we go from here? When I'm looking at your spread at the moment, your average interest spread for 9 months FY24 stands at 8.2% versus the 7.8% number FY23. And it's consistently gone up in a cycle also where we've seen rates go up. So as rates come off, where do you see this go? Because this will therefore percolate on profitability as well. So I just want to try and understand where this goes.
So rate cycle is actually peaking. So as rate cycle is peaking and as our credit profile is improving, we should be able to expand our borrowing to newer instruments of borrowing. For example, today our short-term borrowing is near zero. Without any additional risk on the balance sheet, without any ALM risk on the buckets, we can still monetize some degree of short-term borrowing, which could be in the range of around 3% or 5%, which should help us in further aligning our cost of borrowing. And therefore, and from a margin expansion perspective, we believe that this is a spread or a margin which we should be able to maintain. In a falling interest rate scenario, you'll still get benefit. If we assume rates are peaking and in the next few quarters rates will start coming down, that will help in further drop in your borrowing cost, incrementally new borrowing, not the entire borrowing, so it will come only marginally. With that will help still you're maintaining your spread. So we believe that we should be able to maintain these spread levels going forward as well.
Understood. Sure.
Yeah.
Sorry, please complete.
And in certain pockets, if the opportunity allows, we'll see how we can increase our rate of interest as well.
Yeah.
Hello and welcome to NDTV Profit. You're watching the Portfolio Manager. My guest today is Vineet Arora, who is the Managing Director and Head of Investments Asset Management at NAV Capital, based out of Dubai. NAV Capital is a fund house which is in the Dubai International Finance Center. It has two funds which are registered with Singapore Monetary Authority of Singapore, and it invests in some of the small cap, micro cap, and mid cap companies in India. Vineet, thank you very much for joining us on NDTV Profit. My first question to you is that, a large chunk of your portfolio, you have been focusing on investing in some of the small and micro caps, especially if I see you're one of the largest anchor investors for some of the SME platforms, companies listing on that. My first question to you is that, how do you go about selecting stocks in these small and micro caps?
Thank you, Sajid. Thank you for having me on the show, and good morning, everyone. We've been focusing on SME sector, largely riding on the India growth story. Of course, the selection involves a lot of travel. As I said, I spend about 2 weeks a month in India, and so do two of my analysts who extensively travel across the country, length and breadth. We largely focus on tier 2 cities because that's where you find most of these SME companies doing well. A good hub for us has been Pune, Maharashtra, Ahmedabad, or cities around that. Some in north, some down south, a couple of them in Calcutta. So key is literally actually meeting these companies, understanding the business model, understanding the promoters, because balance sheets get made at 1,000, 2,000, 3,000 crores. At this point, you're looking at companies who've never had access to capital. You're infusing them with capital to take them to next level of growth. So apart from businesses and the promoters, it's literally the family or the people who are running the business. That's very, very important that we look at. And a lot of companies we met long before the IPO process. So sometimes we invest pre-IPO and kind of we see the journey, how they're performing. It's a continuous engagement because data points are very, very sparse and scarce. Rely much on data, but you rely a lot on what you see on the ground yourself. That involves large part of the selection process. Of course, we have our own matrices and parameters that we look at before we invest into a company. If it ticks all the boxes, we go in, but then it needs a lot of patience because one has to be aware that the company never had access to capital. They've just got capital, so you need to give them time to do their capacity expansion, put up a new plant, or build up their bench strength, depending on the business they are in, and work with them, help them wherever required. So it's a lot of mentoring and nurturing involved in the process.
I just wanted to check with you on the process there, because you yourself mentioned that many of the companies don't have a balance sheet. They are first time coming into the public markets, and there's a window for them so that they can list on the SME platform, and once they mature, they can migrate to the main board. How do you finally decide where to invest, because the investing norms are also a little different for the SMA platform. You have market makers who will make for you, make market for you, and entry and exits are a little higher. I mean, unlike the main board, you have a threshold level of investing even for retail, and you come from an institutional background. How do you go about in saying that what kind of liquidity I need before I invest in an SME platform?
So liquidity is again a process. It happens over time as the market looks the value in the stock. Of course, when a stock list, there's a lot of liquidity, but for somebody who's looking at just the initial pop, that works well. But liquidity will dry out after a couple of weeks and then rebuild if the company continues to do well. So some of the things that we look at when I look at a company, the company has to be profitable consistently. It should be growing faster than the industry, much faster than the industry, despite limited capital. It should also have a very small market share, and that goes in line with the growth at a smaller market share. So that becomes a very, very key metric for us. Promoters have to be good in terms of their background checks, and it should have some moat about the business. there are companies that we invested, for example, Enron Technology Services, we invested in the IPO in December, Jan last year, a year back. The company was facing a challenge wherein the government said make in India for certain types of machinery in the airport services sector. And there was nobody manufacturing it. And these were the guys who were servicing it, literally with a 90% market share, very small business, but literally turned out to be a sweet spot. All that company needed was capital to set up assembly lines and take it to the next level. So we like that business. Or if I have to take example of paints industry, let's say Asian Paints has a 59-60% market share, having a CAGR of 12-13%. How far it can grow from here after reach 60% market share? If I have to look at that industry, I would look at a company with a niche market, maybe a 0.1% market share, and it growing to 1% market share with the infusion of capital. So it's a very different approach. Somebody like us would never buy an Asian Paints, but would look at a smaller player who's starved of capital and can ride that growth curve if they get the capital.
Vineet, what could be the holding period for such investments? Because if a lot of retail investors also look at SMEs, and we have seen nearly 148 SME companies getting listed on both NSE and BSE platforms, and many of them during the IPOs have a huge oversubscription that comes in. That also translates into a higher price on listing as well. So what should be the holding period for investors, given the fact that we see a lot of investors in India today who are flippers in the first week of listing?
So bulk of the investors are actually flippers. If you check the data, most of them sell on day one and day two. And especially with the frenzy going on right now, IPOs getting 400, 500, 600 times, some even 1,000 times. It's a question of getting a lottery ticket and winning that lottery, and you sell on listing gains of 100%, whatever 200%, capture the pop and get out. But that's not really the right approach. We never define a holding period, but ideally, if I'm getting into those companies, we would look at least 2 to 3 years for them to actually grow to a level that was envisioned. If a company wants to set up a new plant, the plant will not be set up overnight. It will take probably a year. After that, it needs to, operationalize the plant, kind of drive the growth, drive the sales, make it, in terms of get all the parameters right, in terms of profitability, in terms of margins, etc., some rationalization. So you need to give time. As long as we feel that the company and the management is in the right direction, we will not sell. Rather, in a lot of instances, we've been actually buying at even 2x or 3x the price because we can see where the company is going, where the management is going, and the growth prospects for the company.
And similarly, what will be the exit strategy or exit methodology? Because, as you said, liquidity will be very little. Many of them would have exited during the first week. And if you're holding on for a period of time and you have a substantial stake in the company or substantial shares in the company, exit is not going to be as easy as in the main board. So how does an investor who wants to hold on for a couple of years, exit, have an exit plan for the SME platform?
So a lot of companies, if you see, if there are about 1,000, 1,100 companies which are listed on SME, about 200 have already migrated to the main board. With the new regulations coming in, where now they need to be there for 3 years and meet certain capital criteria. So if you've invested in a bona fide good company, gradually it will move to the main board and liquidity will dramatically change. Having said that, we have not faced an issue in terms of exit. Of course, if you want to exit, you just don't go and place a large sell order, which is not good for the market, for the ecosystem. You do it slowly. In our case, because we have continuous inflow of capital, we are never under pressure to sell. So if you have to exit, we'll calibrate it over kind of a month or whatever time it needs.
Because I'm looking at your, your returns since inception is around 146%. that's a huge return, and given the fact that you have a good exposure to the SME, you're the best person to say how to play the SME platform and trade or invest in SME companies and get returns from there. Do you find that all companies which are coming on the SME platform are able to scale up to the promises that they have made?
Not all, but quite a few of them are able to scale up. So if you see, we probably invest in one of the 10 IPOs that comes in. And a lot of these companies, we've actually been watching and talking to them way before the IPO. It's just that, and that's again a journey. It's a very casual approach where, we speak to about 4 to 5 portfolio companies every day on a casual basis, just trying to see what they're doing, where they're heading. No specific questions, but a normal casual chat. And answers come in, and that gives you a lot of comfort or discomfort as you go along. The key is, if you look at India and as a growth story, now of course we don't have to sell India, but it's driven largely by SME. India's almost 30-35% GDP comes from the SME segment. SME segment generates about 40% of India's employment. There are about 600,000 odd SMEs in India, of which probably 50,000 are listable, and only about 1,000 have listed. So we've just scratched the tip of the surface. There's huge value out there. Unfortunately, these companies have never had capital, never had proper balance sheets, corporate governance. They never knew that they have to do this. But what has happened is, I think since 2016, for me, what I look at is the changing point. When demonetization happened, a lot of these companies were forced to come into the mainstream. Cash business stopped. This was followed by digitization of Indian economy, GST reforms. So now a lot of these companies have proper balance sheets, but not capital. Think of a company having a 30-40 crore top line, generating a PAT of 1-2%. Promoter has a family to take care of, doesn't get bank lines. So whatever he earns, saves, goes back into the business. And with that, he's able to grow 15-20%. Now, if he gets 15, 20, 30 crores of capital, and you can see that he can scale it up to from 40 to 200, 300. And gradually the time will tell whether he can go to 2,000 crores or 20,000 crores or not. But all the big companies today were SMEs at one point, by definition. Whether you look at Amazon or Apple, or in India, you look at any of the large groups, they all started small.
So my final question before we go into a break. We've seen some excesses also happening in this segment, in the sense it's overheated. Regulator is constantly watching on it. There's always this thing of, whether this segment is there is some abuses being done by either the bankers or the investors, or for that matter, companies who are coming into that platform. How do you caution a retail investor who wants to invest in an SME company and stay away from all the red flags?
I think so. There are many merchant bankers in the industry. So my first check for retail investors would be look at the active merchant bankers in the segment and look at their performance, because they are the ones who spend months doing the due diligence. Whether it's creating a corporate governance structure, whether it's preparing a DRHP valuation, etc., etc. So for a retail investor, that's a public data available. There's a public data available on the anchor investors, and you can see their track record in terms of the companies that they've invested, how they've fared a year or 2 years or 3 years down the line, and whether they're still holding the company or not. So I think that kind of analysis, apart from reading on about the company, spend some time on the DRHP, try and get hold of the investor presentation, spend some time on that, rather than just looking at a grey market premium and applying for the IPO and waiting for a lottery. So one has to be cautious, and retail investors can do little due diligence, but there are enough tools available which are more of surrogates rather than direct data points available.
We need to stay on. We'll be back after a short break where we will discuss some of the portfolio of Vineet, where he's invested, especially some of the interesting sectors and SME companies that he has invested in. Stay tuned to the Portfolio Manager. Welcome back. You're watching the Portfolio Manager, and I have Vineet Arora, who is the MD and Head of Asset Management at NAV Capital. Vineet, let's take us through your portfolio. You have roughly you spent 20% of your investments in pre-IPO, and then followed by micro and small cap, which is 60%, and then you have 20% cash. What is the reason that you keep 20% cash? Is it because you need to have that dry powder for this quick investment, or the secondary market opportunities that you look for?
So over the last 2 months, our cash holdings have gone up, largely because we've seen some froth in the market, and we are being extra cautious by holding some cash, waiting for some corrections. The second reason we hold substantial cash is sometimes when a good opportunity comes in a pre-IPO space, and you need to move fast for that, you need to have cash ready. It's your ability to actually give capital to a company when it really, really needs it. And as investors, it helps you to get a better price point of entry pre-listing. Third reason we hold cash is because it's a liquid fund. So if somebody wants a redemption, we don't want to be under pressure to sell anything. Mm-hmm. That's largely three reasons that we hold substantial amount of cash at all point of times.
So if I look at your sector allocation, you have RAS, which is a sector. Can you explain what is that for us? And you have nearly 20% allocation to that sector.
So 20% has grown because of the companies that we invested have grown multifold from the time we invested. But it's quite an interesting space. So I met a promoter about 2 years back, slightly more than 2 years. He was running a managed offices business, looking to list his company, trying to raise capital. Around the same time, WeWork India raised about $300 million at $1.2 billion valuation, operating 64,000 seats. We looked at this company, $10 million valuation, 18,000 seats and profitable even during COVID. Understood the business and why others are not able to crack the code and this guy is. And we went and invested in the company. And we participated in subsequent rounds as well. Stock has done almost 23x from our first round of investment now.
Which is this company?
This is called EMS India Limited.
Okay.
So now the market cap is fully diluted basis about 2,500 crores. But first investment was at 85 crore rupee valuation. So if you compare 1.2 billion to $10 million, 64,000 seats to 18,000 seats, loss making to profit making, I think it was a no-brainer at that point of time. We also invested in a company called TCC Concept. Again, it's been 2 years of journey now. Now we've kind of started to see the fruits where the company is ready to launch its products in the market. Path breaking on the real estate side again, more on the real estate services side as commercial broking and allied services. But again, they've done some phenomenal work in the last 2 years and we've seen the journey.
So within the SME space, which are the sectors and teams that are working for you? Because as you go to mid and higher, the sectors are very broad in nature, but the teams are not there. But you get those teams in the smaller companies and micro cap companies.
So some of the companies that have worked well for us are in the IT space or IT services, but not like a servicing model, what a Wipro or a Infosys would do, but very, very niche players who are, either imparted trainings or making modules for some of the larger players, doing some back-end work, but which is high-tech. Some of the investments have done well on the, for example, digital studio side, which I would put in the same basket as technology. Drone sector has done very well for us. We were the anchors to the first drone IPO, which was Dronacharya in India. The third one, which is Drone Destination. We did not invest in IdeaForge because we found it a bit too expensive. So these have done well for us. In general, ancillary services across sectors have done well. We've done spices, we've done semiconductors. As we talk, we are investing into the company which was our first investment from the fund, which is a fintech SaaS platform, which is scaled up very nicely, highly profitable, and kind of now we're looking for ways to take it public. So we are doubling down or tripling down now when kind of it's right.
And you're also invested in consumer appliances, right? Or consumer segment through Inflame and other companies as well.
Yes.
So how do you see that market growing?
So consumer sector in general is doing okay, but of course, it's driven by spending, and especially the rural side has done quite well. So a case in point would be FMCG company on the spending side, Annapurna Swadhisht, wherein we did pre-IPO at 40 rupees. IPO came at 70, and I think it traded 330 or something. We continue to hold. We haven't sold. Inflame has done quite well. They're into appliances manufacturing, but they're more of an outsourced player where they supply to larger players like Havells, etc. So this is like, you investing into a Dixon, which is onto the appliances and TVs and other things. This is the lower end of similar segment.
Mm-hmm. And what about pharma and healthcare? I mean, I see Sotac Pharma is one of the companies where you have, some investment.
We invested, we continue to hold. Fantastic team of people running the company, very, very down to earth. They've set up a new plant which is just becoming operational. So we'll start seeing the traction now. Again, we invested almost a year back. I think the IPO came in April last year. So you need to give time for the plant to come up, the capacity utilization to come up, the efficiencies to start showing. But we stay invested. We invested in Trident Pharma. That's done decently well. Again, we stay invested. That's more on the intellectual property right side of business, API side of business. This is more on the manufacturing side. So same industry, but different segments.
Mm-hmm. Finally, you have sizable stakes also in this. It's not just that, some shares, but you have sizable stakes. Do you guide them through the process of moving from a SME platform to a main board as well as investors, long-term investors in these companies?
Yes, we do. As I said, we talk to 3 to 4 companies on a daily basis. probably meet all of them in a 6-month period.